Hi again. Let's get started with part 2 of Chapter 6, where we're going to focus on control over cash. As a reminder, cash is listed at the very top of the current assets section on the balance sheet because it is the most liquid of all the assets. Good accounting systems help in managing the amount of cash and controlling who has access to it. Liquidity refers to how easily an asset can be converted into cash to be used to pay for services and obligations. Liquidity also refers to a company's ability to pay for its near-term obligations. Cash and similar assets are called liquid assets because they can be readily used to settle such obligations, and a company needs liquid assets to effectively operate. On the balance sheet, cash is combined with cash equivalents. Cash includes currency, coins, and amounts on deposit in bank accounts, checking accounts, and savings accounts. Cash equivalents are short-term, highly liquid investment assets meeting two criteria. First, they are readily convertible to a known amount of cash, and secondly, they are close to their due date so that their market value is not sensitive to interest rate changes. Only investments purchased within 3 months of their due date usually satisfy these criteria. Examples of cash equivalents are short-term investments in assets such as U.S. Treasury bills and money market funds. Now, cash is one of our more vulnerable assets because whoever possesses it effectively owns it. To protect cash, 3 processes should be implemented. First, those who handle cash should be separate from those who keep records of cash. For example, the store's cashier or the person opening the mail must never also have the ability to make entries in the accounting records. Second, cash receipts should be deposited daily in the bank to prevent theft. And third, cash disbursements should be made by check. While many companies choose to process payments electronically now rather than by check, it's important to make a payment in a form other than hard currency so that a paper trail documenting the payment exists. Now, again, because cash is the most liquid asset, it's the most susceptible to theft. And so, as a result, controls over cash receipts are very important. Businesses can receive cash in 2 ways. They can receive it in person, over the counter, at the time of a sale, or they can receive it from a remote source, such as a payment on account. Please do review the textbook to learn more about control over cash receipts. I will expect that you have a basic understanding of them. Control of cash disbursements is especially important as most large theft occurs from payment of fictitious invoices. One key to controlling cash disbursements is to require that all expenditures be made by check. The only exception is small payments made from petty cash. Another key is to restrict access to checks to the person who has the authority to sign the checks. Now, as was the case for cash receipts, please read more about cash disbursement controls in your textbook. A basic principle for controlling cash disbursements is that all payments must be made by check or electronic payment. An exception to this rule is made for petty cash disbursements, which are the small payments required for items like postage, courier fees, minor repairs, and low-cost supplies. To avoid the time and cost of writing checks for small amounts, a company sets up a petty cash fund to make small payments. I'm not going to discuss accounting for petty cash in this video, but I would like you to review it and understand the entries. You should be able to practice the concepts in the homework assignment. I think it's fair to say that most of us no longer hide cash under our mattress. When we receive our hard-earned paycheck, rather than cash it and slide it into a hiding place at home, we drive right over to the bank and deposit it there. Or better yet, we don't even have to handle the check because we have elected to have our employer directly deposit it to our bank. Use of a bank is a strong internal control because it is far more secure than a mattress or a safe at the office. Let's not stop there, though. Anyone who has a bank account should prepare a bank reconciliation on a regular basis. Everyone makes errors, and if you don't prepare a bank reconciliation, you are banking that the bank and you will not make any errors with your money. Now, moving on to a different subject, when companies fail, one of the most common causes is their inability to manage cash. Companies must both plan for cash receipts and for cash payments. And the goals of cash management are twofold. First, a company must plan to meet cash payments when due, and second, they must keep a minimum level of cash necessary to operate. To state cash management goals simply, we want to collect cash as soon as possible, hold on to it as long as possible, and invest any excess in productive assets. An important part of cash management is monitoring the receipt of cash from our receivables. Now, because most companies sell on credit to attract customers, cash receipts from customers are delayed until accounts receivable are collected. If customers who owe money to the company delay their payment, the company might find it difficult to pay their own obligations when they are due. One measure of how quickly a company can convert its accounts receivable into cash is the days sales uncollected, also called the days sales in receivables. Now, this measure is computed by dividing the current balance of receivables by net sales over the year just completed, and then multiplying the result by 365. That's the number of days in a year. The ratio is affected by several things, including a company's ability to collect its receivables, its customers' financial health and payment strategies, and discount terms. To properly evaluate the ratio, we should compare this estimate to that of other companies in the same industry. We also make comparisons between the current and the prior period. With that, we'll take a break and pick up next time with a review of a very important control over cash, bank reconciliations.